Hello over the peak. Here we go for a brand new week and the Joker chart. That kind of saved the day, coming in at really, not very bad on Friday, but you can see that in the overall scheme of things it hasn't really helped much at all, has it? No. Still looking shocking. Muriel Robini gives us a tweet. QE3 started in Japan and Switzerland via forex action and or monetary easing. Fed will eventually get to QE3, but it will be too little too late. Japan and Switzerland, their currencies are too strong for their liking, so they're trying to debauch their currencies any which way they can. This is a Doug Short chart, the S&P Federal Reserve intervention. And if we start off over on the far left with the first little speech bubble, Bear Stearns hedge funds collapse. Now, we're over 4 years after that now. This is just to give an idea how long this has been going on. The summer of 2007 is when this officially started kicking off. 4 years, it's a long time. So Bear Stearns hedge funds collapse. It took a couple of months after that for the S&P to reach an all-time high. That's the blue line at the top. And if we follow the red line down, which is the Fed funds rate, which looks like it's probably the effective Fed funds rate, we get the eventual collapse of Bear Stearns in early 2008. And 2008 was a calamitous year with the Fed and Treasury, government, everybody trying to do everything they can. And in that light blue background, we get PDCF, TALF, TARP, etc., all those things that we never really understood. But it didn't do enough good, because towards the end of the year, Lehman blew up, Merrill Lynch, and there was carnage, absolute carnage. So 2009 came on, and the TARP, etc., and all those other funny things continued, but the first quantitative easing kicked in, and that was the dark green, and that was buying up all the mortgage-backed securities and taking the rubbish off the bank's books and relieving some of the pressure. The S&P in blue reacted to this, and in green there we've got 10-year Treasury yields went up, and everyone was thinking that life was not too bad. But we can see the effective Fed funds rate is just crawling along the bottom of this. That took us to 2010, which was a bit of a boring year. Nothing much happened, but it was looking like there might be another double dip. So Ben comes in with QE2 because the S&P was going down, that blue line. That kicked the S&P up again. The 10-year bond market could see there was trouble, and the yield was coming down, the price was going up, people were buying treasuries, going back to safety. QE2 put the yields up again because everyone thought that it was safe to go out there. They went into the S&P. The S&P went up again, and we can see we've got double oops again, which is people pulling out of the S&P, out of equities. But you can see that the Treasury yields on the 10-year have been going down for about 6 months. The Treasury yields, the bond people have noticed that there is still an awful lot of anguish out there in the world and chance of a deflationary depression. So the equity market caught up last week, and it will just take a little bit of time, according to Doug Short here and Muriel Robini, before the Fed comes in with QE3 and probably some other fancy stuff. If you had to bet what they'll go in for, it'll probably be longer treasuries, the 30-year, the long bond, and maybe even muni debt as well, to try and help the state and local governments. Maybe, maybe not. Anyway, moving on. Business Insider, S&P calls Obama's bluff. That was the big news after the markets closed on Friday. US credit rating downgraded again. S&P calls Obama's bluff. S&P, the sophisticated people know that it's not that important. But I would like to note here that the world is not full of sophisticated people, and billions of unsophisticated people will bump into this information and just store it away in their brains, not knowing what to think about it, but knowing that it's not particularly good for the United States of America. And the author here, Russell Haley, has called it downgraded again because, as we read, S&P is not the only game in town. In fact, although there are 10 top credit rating agencies recognized by the Feds, S&P and Moody's and Fitch are unquestionably the big three. Among the lesser-known outfits is the fiercely independent NRSRO, Egan-Jones. Unlike their competition at the big three, and this is quite important to note, Egan-Jones is not paid by the bond issuers, but rather by the bond investors. If Ford issues a bond, Ford do not pay Egan-Jones to rate that bond. If somebody is thinking about buying Ford bonds, they will pay Egan-Jones to have a look at those bonds for them and rate the bonds for them. A completely different way of looking at it, and when you think about it, obviously the more sensible way of doing it. Egan-Jones is not paid by the bond issuers, but rather by the bond investors, the only agencies that does not have that inherent conflict of interest. Their record on purveyors of these toxic assets that led up to the financial crisis of 2008 was far better than their competitors. Egan-Jones downgraded the US the weekend of July the 18th. Their report is quite detailed and ends on this note. Egan-Jones does not view a country's ability to print its own currency as a guarantee against default. Oof. Dangerously honest bunnies there. Reuters gives us what China thinks of the S&P and their downgrade in a harshly worded commentary by the official Xinhua news agency on Saturday. China gave its first official comments on the United States losing its gilded AAA term credit rating from Standard & Poor's. China, the largest creditor of the world's sole superpower, has every right to demand the United States address its structural debt problems and ensure the safety of China's dollar assets. China also urged the United States to apply common sense and cure its addiction to debt by cutting military and social welfare expenditure. The US government has come to terms with the painful fact that in the old days, when it could just borrow its way out of a mess of its own making, are finally gone. That's telling you. More important, back at home in the United States, New York Attorney General Schneiderman drops bomb on Bank of America's settlement and Bank of New York. That's Bank of New York Mellon, I would imagine. They just as an interesting aside, now if you want to deposit, say, a chunk of change like $50 million, something like that, with BNYN, you have to pay them for the honour and privilege of holding your $50 million because they just don't know what to do with it safely that will make any money for you. So you've got to pay them just to hold it. Anyway, this is Bank of America more, and if we move on to the second article, we can get a better idea. Bank of America Death Watch. This blog is now starting a Bank of America Death Watch. This is Eve Smith, Naked Capitalism, and it's all to do with this mortgage mess about. And Bank of America have the extra problem of their own crap. Then they've taken on Merrill Lynch's crap. Merrill Lynch, that's right, isn't it? Yeah, I think it is. And of course, the wondrous Countrywide. And it's all stuffed into Bank of America and they are struggling to contain it all. Over in Europe, here comes the rescue. The bazooka is seemingly being readied on Friday afternoon. For some reason, the ECB, towards the end of last week, were buying up. This is why, while Spain and Italy were blowing up, they were buying Irish and Portuguese debt. Don't know why. Just to make a point, I suppose. But I don't know what point. But basically, we get this from Reuters. Italy expects fast-track welfare reform. Leaders applying intensive pressure on Berlusconi to make an announcement. The ECB say they might buy Italian bonds if Berlusconi moves the austerity forward and hits it harder. Cullen Roche, Prague Cap, Europe pulls out another pellet gun. The big news today is the ECB will buy Spanish and Italian bonds. Italy is also announcing a balanced budget amendment. The comedy of errors continues. We've seen these movies before and we know exactly how they end. Italian austerity will not fix this problem, as we saw in Greece. Austerity will only exacerbate the issues by shrinking the economy while ignoring the problem of aggregate debt levels. A balanced budget amendment is not what Italy needs right now. It's in many ways no different than the situation the USA is in. As a current account deficit nation, the balanced budget amendment will shrink the public sector while the private sector and foreign sector both act as drags on the economy. This means the Italian economy will shrink, like the USA economy will shrink, and ultimately make their problems worse in the near term. And if your problems are worse in the near term, generally what happens, your problems are worse in the medium term and long term. The Economist has put together this interactive chart type thing. If you follow the link, you can see the horror of this. They've been very cruel to Britain, The Economist. Overall debt. Britain has been put in with Japan at over 400% of GDP debt and has gone red with Japan. The dark reds are over 300%, including Italy, France and Spain. Big old problemos. But out there, the global financial stock is growing and it's now surpassed pre-crisis heights, totaling now $212 trillion. And this is McKinsey information. And if we follow them up, surprising one at the bottom is non-securitized loans outstanding. Oh, non-securitized. Okay, that's not too bad. I understand that now. At about 50 trillion. Securitized loans at 15 trillion. Non-financial corporate bonds, Ford bonds, for instance, at 10 trillion. Financial institutional bonds outstanding, $42 trillion worth of banks' bonds. Public debt securities, that has come from 30 trillion and is now over 40 trillion. And stock market capitalization, which took a bit of a hammering last week, was 54 trillion when we had up-to-date information. It was the end of 2010, making a total of global financial stock of 212 trillion, and that's to be divided up between the people. Some people think they own all that wealth. Finish with this one. It's from the UK, and it's a simple little chart, and it paints a simple little picture that you've got the bottom fifth, next fifth. These are the people with, they've divided the population up into 5 lots. The people earning the least, you can see how much state support they have to have in blue just to stay above water level. More is coming in state support than it is in earnings or other income. Even the next fifth up, if you add together state support and, really state support should be different earnings and other income, but you can see it's a substantial amount for the next fifth up. Even the middle fifth, state support is quite, what is it, 15%, would you think there? It's quite a percentage of their household income. But it's those two bottom fifths, and the amount of state support that they need is quite shocking. And that's really going to come under severe pressure when the government start either running out of money or having to print money to pay for everything, quite frankly. Leave it with you. Start for another week. Let's do it. Bye.